cash edge, you can close as cash. So you have to do full underwriting up front, and we have to have 10% down payment. So this can come from gift funds. You can do a Heloc, anything. And the whole idea is that you can close and it's not subject to an appraisal. We do order an appraisal, but not subject to. So you can close just like cash. So if it's a really competitive property and they're planning on putting at least 10% down for conforming or high balance loans, so 891 loan amount, and then anything in the jumbo, they'll have to come up with a little bit more down payment. Okay.
Okay.
Makes sense so far?
So far, so good.
So no contingencies, cash. Really competitive. A lot of other companies are doing not as high loan amounts. So this is really competitive for people in that jumbo price range. We can't do it on new construction deals, FHA, VA, or USDA loans, HFA programs, down payment assistance programs, again, because we're not in control of the underwriting for down payment assistance programs. So we can't close like cash for that. MCC is different. Purchase money seconds.
What's MCC?
It's a lower income kind of assistance tax break loan program. Yeah. Manufactured homes, condominiums, because there's too many variables in that. So it's a single family home or a townhome that we can do these on. And they have to be moving into it. So it can't be an investment property purchase or anything like that. They have to be minimum of 720 credit score. And then these max debt to income ratios are a little smaller than sometimes we can get people to. So little more constraints with it. The cash edge is going to be a 6% interest rate. So it's a little more costly, but it's an option, and we can decide to close with their purchase if they can end up closing with it, and not do the cash, but still provide the proof of funds letter to the listing agent. What else is important here? Oh, so if they're doing anything less than 20% down, then we're going to have to show more reserves. So they have to have more funds available. That can be 401k, investment accounts, things like that. So it's an interest only payment for the next 4 months is like the standard, but it can go up to 7 months that they can purchase and hold on to that loan and then sell their other place or refi into a conforming loan.
So any payments they make on it while they're selling their house is going to be just paying the interest. That's it.
Yeah. So it's a smaller monthly payment during that time.
Okay.
And then it's a 1% origination fee, but once they refinance, then they'll get a credit back. And it's 0.5, which is pretty competitive. It's not a huge cost like some of our bridge loans are, more expensive. So this is like a bridge loan, but next level, easier to qualify for and to purchase because you're only qualifying on the purchase rather than both payments like a bridge loan would be.
Okay.
Yeah. And we can do a Heloc. We have a Heloc contact that we can get Helocs done in about 3 weeks to prep, and they have to do full underwriting beforehand. If there is a property of interest, we have to do an AVM with our production team. So that can take a little bit of time. But then they'll give us.
Sorry. How much equity would they have to have for a HELOC?
Usually you can go up to like 75.
Okay.
With our Heloc contact. Yeah. We're not in control of it, but we have like a trusted person that can do that. If they need to pull equity out, it's a little less costly than doing like the bridge loan. Dave likes to do Helocs over like a bridge loan because it just makes more financial sense most of the time.
Right.
Yeah. What do we got here? Okay, so this is kind of the workflow of everything. So you're going to have full CIA approval. So that's credit, income, assets, all verified. And then they'll sign an agreement going over kind of the terms of a cash edge. We do the home, find that. And then we request the proof of funds letter. And we don't need to do an appraisal to give the proof of funds letter. We send it off. Offers accepted. We order an appraisal, but that doesn't affect anything with financing. We just have to have it for the eventual refinance or closing in a standard loan. And this is a little bit of the processing side of things. So
can I ask, stop in the middle there? So
yeah.
It will be based off of the two AVM, and what's the automated value, or what's AVM?
Yeah.
So, and what creates that, the AVM?
Who creates it? Our like production team that's in charge of double checking everything. So we have no control over the AVMs.
So if we want to, use this program, we find a house, the house is priced for 800,000, and then the two AVMs come back at 750, we're dead in the water.
They can come up with cash to make the difference. Yeah.
Right. But
yeah. So that's one of the troubles. We're not sure what the AVMs are really doing because this is a brand new program.
Sure.
Yeah. But that is something that could happen.
Okay.
Yeah.
But once our two numbers match up, then we're good. Then there's
then you're just a cash offer. Mm-hmm. And then you can make up the difference, from anywhere.
Can you go back to that first screen as well? What are we talking about as far as timelines? Do you know? So let's say I send you a buyer tomorrow, right? Yeah. And we're like, okay, we want to try this cash edge program.
Mm-hmm.
When do you think we could start making offers?
So we have to go through full underwriting. So 72 hours. If they're fully engaged, get us everything, go through full underwriting, and then they'll sign this cash edge program agreement. We'll go over the terms with them of what it'll look like. And then the AVM we can do same day on the property. So, technically 4 days, we could be ready if they're fully engaged. Is that quick enough?
Oh yeah. It's just curious, because that's like all these different steps, and you're like, wow, how long could this take? I don't know, right?
Yeah. So full underwriting, and then an AVM should be same day. We have the property and what your intended offer is, and then we request the letter. We send it. You put the offer together. And make sure the listing agent understands that we are going to order an appraisal, but it's not subject to an appraisal. It's a cash offer. And then in the middle of the process, 10 days before close, we can decide to either close like conventional or jumbo or with a cash edge. So not ideal to use cash edge because it has that 1% origination fee. But it's just an extra, tool. And this can be a first-time home buyer. It can be anyone. They don't have to have a departing residence. But if they do have a departing residence, they don't have to qualify with both payments. So, Tree, do you have a question?
Yes. What is AVM?
An automated value.
Oh, okay. So it's like a comp, or?
Yeah.
Oh, okay.
Yeah.
Gotcha.
So it's gonna. Yeah, they're going to just run an automated value, and then we can only lend up to that amount. So they'd have to make up the cash difference. But if it appraises later and we can close, with an extended close time, we don't need to close cash, then we can use the appraised value and close conventional or jumbo.
Sounds good. Thank you.
Yeah, of course.
And then the 1% fee, so do they pay that up front? Like, how does the kickback work then? 'Cause
Yeah,
why
so that's
wouldn't it
part
just
of,
be a 0.5%?
yeah, so that's part of the closing costs of the loan. So we have to do the 10% down and then closing costs.
Right.
And the 1% fee will be with the cash hedge. But if they end up closing just in a conventional or jumbo, then we're not going to do the 1% origination fee. It's only if they close cash edge, it's a 1%. And then when we refinance later on, they get the 0.5 back as a credit for closing costs in the refinance.
Okay, so for example, my client's house is gonna sell for around 500,000. The house that he wants, we want to try and get it for 650. So it'd be 1% of that, or 10% would be based off of the purchase price.
Yeah, so the 1% fee is going to be the loan amount, I believe.
Okay.
Yeah.
And when you say loan amount, are we considering the 20% down?
Yeah, so
Okay.
if it's 650 minus 20%, and then that'll be the loan amount.
Okay.
So 1%. So, yep, order appraisal, finish processing, and we're underwriting both loans. So you can do the permanent purchase loan, or you can do a cash edge loan. Either one, depending on how quickly they want to close.
So
Good.
he would need to come up with about 53,000 for his 10%.
Mm-hmm.
Okay.
So,
I have another question.
Okay.
So, so honestly, like, so we have to be like really sure with our cons in order to, like, if let's say we want to waive financing,
Yep.
like we got to be like really on point with our comps, right?
Well,
Because then if the comp doesn't, like the AVM comes back and it's lower, and the buyers have to come up with the difference in cash, or else they're not going to be able to get financed. And then if they
So-
waive financing, then they have to like basically go through with cash, or right?
Yeah, so kind of. So before you even put an offer together, we're going to do the AVM beforehand. So we'll know exactly what it is. So
Okay, perfect.
once they're fully underwritten and they have, they want to move forward on a house, then we just send in the property and the loan file. They'll run the AVMs and give us the amount or the proof of funds letter. So the cash letter saying
Okay.
they're approved for this much, we can close super fast. It's not subject to anything. It's cash.
And then for the 10%, you said it could be a Heloc, right?
Yeah, so you can do a
Okay.
HELOC, you can do gift funds. Yeah.
Okay. So, I mean, realistically, the client will pay a little bit in interest until they are done with the deal and it gets kind of refinanced into just the one home that they're buying, right? So it's just kind of like a transfer situation, and then, okay.
Yeah, and also this is for like a first time home buyer too. If it's a
Oh,
super
okay.
competitive property, they don't have to have a home to pull equity out of, but they just do need 10% down for
Oh, okay, so
conventional conforming.
So they don't even have to have a house. I mean, because he
No.
owns his house. Okay.
Yeah, so this is just like your cash offer, not subject to anything.
Wow.
Yeah, it's a really cool program. So if it's a really competitive property, we'll be able to close super fast. And it's a proof of funds letter, not subject to anything. So
Right.
Then, okay, so then for the fees, so we got the loan itself just requires 10% down. That's just, and that's fine. That's
yeah, so we got 10% for conforming or high balance.
right.
So 891, 250. And then if you're going up into jumbo
Yep.
loans, you got to do 20.
Okay.
And then if you're going over 1.5 to 2 million, you gotta put a lot more down.
35%.
Yeah.
Okay.
Mhm.
And then a point for the financed amount and a interest only payment at 6% for however many months it takes to what?
To either refinance into their loan, or if they want to recast, they're selling their property, they want to recast and change the terms of their loan,
Mhm.
then they do that.
Okay.
Mhm.
Oh, right. Because this
They-
is like for if I want to then sell my house and then just pay that loan off.
Yeah, or it's like a super competitive property and they need to be cash buyers.
Right.
It'll cost a little bit more, but they can refi.
Okay, so they're not locked into that 4 months.
No, it can be sooner. Yeah,
Okay.
yeah.
And oh, I see. Okay. So then if I sell my house, I pay off this loan, at that transaction, I get half of the fee back.
Yeah,
Okay. But if
Yeah.
I do transition into a standard a priority loan, then the fee sticks.
if you go to a different lender for your permanent financing, then you pay that fee. But if you're going into permanent financing or you don't use the cash edge to purchase, you end up just doing a loan, then the 1% origination fee isn't in there. It's just to use the cash edge and close with cash. And it'll close in their name. It's not like we're the owners of the house, like some of the cash offer programs are. Still in their name. But it's short-term financing.
Right.
So
So I'm curious. I'm trying to get a little bit more clarity on when you get the half a point back.
when you go to permanent financing.
Okay.
So that could be like, the next week or, 2 weeks. Because you're just closing as cash and we're lending at 6% interest only for 4 to 7 months. If you need to sell your, previous home and then refi and use that funds, you refi into your permanent financing and that 0.5 is returned back during that permanent financing transaction.
Okay.
That makes sense?
Yeah.
Okay.
So basically, this is just like a temporary financing, and then you have to get a more permanent financing. And then if you do it with Cash Edge or with you guys within like the 4 months or whatever, then you just get the 0.5% back anyways, right? And then the permanent loan need to be closed within 45 days.
So the permanent loan can be anywhere from 4 to 7 months, depending.
Okay.
Yeah.
Okay, gotcha. Thank you.
So if they need to sell their house and they want to do a few things, they have a couple months before they need to list their property and go into permanent financing.
Got it.
So just closing as cash. If you need to close quickly, they don't have to have a departing. They can be first-time home buyers, but this is just so that they can have a proof of funds letter, not subject to the appraisal. Because we'll close with an AVM. Pretty cool. Super competitive.
Awesome stuff.
Yeah.
I wish I
Treating
had this 2 months ago.
I know. They just launched it too. We're allowed to fund these in the next 2 days. So
Nice.
Nice.
yeah.
So we haven't done one yet.
I believe another team has. They're only giving access to top producing teams. So Dave has early access to it.
Okay.
Woo!
Little fancy.
Did we talk to them, see what the experience was, how it went?
Yeah, it went good. They launched it in another area as well, I think down in Texas. But yeah, I mean, it's good. The whole team, everyone's been through multiple trainings. I think there's been 3 or 4 in the last 2 weeks. So
Cool.
no hiccups.
This will still be, I think, relevant in on the east side, probably for a while. Probably a little bit less so in Snohomish County and such, but maybe Edmonds Bowl, Ballard, some of these higher interest areas will probably still need competitive offers for a bit.
Yeah, and I feel like it's way easier to qualify for it than a bridge loan too. So if people were looking at, doing bridge loans before, this is a great option.
Well, and it still looks better than a contingent offer,
Mhm. Yeah. Tree, do you have a question again?
No, I don't. I think the hand is still there. Let me lower my hand.
I'm all right. Not sure if the hand is just staying up there or not.
All right. And so, okay, let's work through this too. So if I need to sell before I buy, oh, right, because I don't have to qualify for both loans. That's the big,
Huge.
okay.
Yeah.
And how is that possible? Why is that possible?
There are underwriting guidelines that we're doing. Hi, David.
Let me ask you this. It says right there that you have to have the home listed first.
You do have to list it, but you don't have to sell it.
Yeah.
You have to list
We
it. you don't have to
won't,
sell
we
it.
will not qualify with both mortgage payments.
Okay.
Because we have magic guidelines, Jason. Great. No, I mean, basically they're, you do have to have money down on the new one. And I don't know. I don't think that there's any equity requirement on the departure residence, if I'm not mistaken.
Really?
And anything on that, Leah, that you have on your departure?
No, I mean, the trainings that I did, I didn't learn anything about equity on the departing.
Yeah. I mean,
Bless you.
that alone is really big, although I don't think it comes into play too often these days with everybody having gained about 30+% appreciation in the last 12 months, but
Yeah, for sure. Well, they also require pretty good LTV ratios, which kind of makes up, and then you just have the interest only. What is like a 6% interest only on, I don't know, 800,000?
I mean, so that's going to be, what is that? 4,800, 6% times 800,000 is 48,000, sorry, divided by 12 months. It's a $4,000 payment. Hopefully that's maybe a month, maybe 1 month they have that. And that's why they do want you to have some reserves.
Mm.
This
can
is a
use-
cash purchase outside of
doing-
the state.
You say outside of Washington?
Yes.
Oh.
I'm not licensed outside of Washington. I would need to,
Okay.
we probably can do it if the, I could refer it to, what state is it, or you're just saying in general?
Vermont.
I don't even know if we have anybody licensed up there,
Are you
so.
being serious? That's a funny question. That's so random.
I don't even know where Vermont is, so no, I'm kidding. Yeah, no, okay.
Where they
It's
make,
just that
that's where they
some
make the
clients-
syrup.
Yeah,
How about in Canada?
can go up there and start
Different
making
countries, guys.
candles and chopsticks.
How about China? No.
I want to remind everybody, this is being recorded.
Oh yeah, I forgot already.
I was actually serious, so
Well, we have some clients that are selling in Whidbey Island that are going to be moving to Vermont.
Oh,
and it's pretty competitive over there. Homes are going just as fast as they are here, if not a little bit faster.
really?
Yeah.
Vermont.
Like syrup on your pancakes.
Isn't that where Alexa wants to move, Dave?
And she changes it about 2 weeks. It was Ireland not long ago, and she wanted one of those little stone huts,
Mhm.
Oh my gosh.
jaw roof or something, a fairy tale. But anyways, I think that this is cool. The only thing is, remember, we can't do it on condominiums
Mm.
or mobiles or manufactured.
What about townhomes?
What about
A
rural?
townhome
property?
would be considered a condo.
It would, okay. I figured.
Yeah.
It has an HOA, is that why?
Well, no, because a
Well, if
PUD,
it's a-
you can have a single family plan unit development that has an HOA.
Yeah.
We
You
would
can do
do it
that
on a
one.
PUD.
What about rural properties?
What does that even mean?
Yeah,
I don't know. I know that no more than 5 acres, but yeah, I don't know about that. I didn't remember.
Do we even have rural properties out here anymore?
Chris has some clients that are selling that are trying to go to rural property.
Well, the Whidbey Island is on over 6 acres.
Yeah, that's not gonna work.
So this is on the purchase, right?
Yeah.
Yeah. Remember, this program is for purchasing. It just also can work as a replacement for contingency, but it's for the purchase of a new home.
Okay.
Yeah.
Yeah, and it could be a first-time home buyer that uses this. It's not just like a bridge loan.
Cool.
It can work like a bridge loan. It can be for your first-time home buyer that's got 10% plus down payment.
So they just need to have some cash on hand and then be able to carry that loan for a month or so.
Well, I don't understand what would benefit a cash or first-time home buyer to do this program.
Well, if they don't get the house, they're not going to be a buyer. Like this helps them get the house.
Okay.
Because it makes
I
your
mean,
opposite cash.
so they're going to be able to, your first time home buyer, maybe they normally would say, oh, I need to do, a 3 or 4 week close and I have a financing contingency where they can use this cash edge and they're basically putting in a cash offer.
Yeah.
No contingencies.
Okay.
So Dave, when we send people your way, is this something that you present as an option? Or do we have to kind of mention it for them to ask you about this?
Well, if you know that they got some down payment money and you feel like it could benefit them, I would say to bring it up with them.
Okay.
Yeah.
Cool.
I mean,
Perfect.
ideally, I don't think that you would want your client to close this loan if they don't have to, because it's more expensive. They're going to have that 1% origination.
Yeah.
That's where it's Tree's right. 4 or 5 months ago, it would have been like, shoot, when you get like that $700,000 buyer in Edmonds or Lynnwood or whatever, and you're like, that's like, it's like enough money kind of, but not really if we get in a multiple bid situation. But maybe if you were a cash buyer, you could definitely, win some of these. For that, it would have been perfect, right? Which is we're just not going to be seeing that probably right now. So in practical uses for us, if you're in a super highly competitive area, i.e. Bellevue or Kirkland, maybe the Edmonds Bowl, it's still viable. Or I think as, if you need to sell first and then buy. But
honestly, Jason, I'm feeling like we just try to do this for everybody that we can, because you just don't know.
Yeah.
You don't know what they're going to run into for competition. You know what I mean?
Well, that's what I was wondering, if we could pivot. And it's like, because if it's not going to be super ultra competitive, saving some money on the origination, then we go conventional or whatever other loan product. But then pivot to this if it's a home, and we're afraid we're going to lose out on it. Does that make sense? Or
yeah. So you could present the offer. If you talked with the listing agent and they had 4 other offers.
Yep.
You pull this out of your back pocket and we show them a proof of funds letter, the thing.
Yeah.
If they say, well, this is great, I like this, Chris, but we want a 3-week or we want a 30-day close. We want our clients want some time to get out, blah, blah, blah. Then we would just close a regular loan.
Right.
Instead. We won't have any contingencies still. We're still ready to close this cash edge, but we'll close the regular loan to save your client money.
Oh, okay, that's cool. Yeah, so we show them that we can perform and execute based on this proof of funds letter, but also we could, because on financing addendum, this is still just check the conventional box, right? Or is there no financing?
If we have, you'd probably throw the financing addendum out of the contract.
Right.
So no appraisal.
That's what I was wondering. Would it go in as a cash buyer then? Because you're going to show proof of funds.
Oh yeah, there wouldn't be an appraisal because you're basing this all off of the AVM anyways.
Right.
Yeah.
Okay.
Yep.
Wow.
Well,
Cool,
there technically is an appraisal, which is kind of confusing.
Yeah.
Right.
Yeah. And I'll have that conversation with the listing agent, letting them know this has no bearing on anything here, but we need this. the idea is this is a temporary loan to help them buy the house. Use the terminology loan, that might be a turnoff, but we're guaranteeing this, but we're going to refinance them immediately after they close.
Okay, got it.
I can explain that to a listing agent and it makes sense thing. Like there are no contingencies on this offer, but it would raise a question, I think. Like if you guys had a listing and has anybody closed with another power buyer program or had a listing where somebody used one? I'm
Well,
curious.
like Fly Homes.
Fly Homes, we used Fly
Yeah.
Homes probably 3 years ago, I'm guessing.
Mhm.
You guys had a listing that Fly Homes bought?
Yeah.
Mhm.
Did Fly Homes buy it in their name? I forget how Fly Homes.
They did. It was weird because they had to switch it to that for some reason. They were trying to go with conventional financing. I don't remember the reason, but they ended up just doing their cash buy.
Mhm.
That's what's so cool about ours, I think, or one of the cool things is your buyer will buy it. Like if I'm selling a house, I don't want to sell to Fly Homes. I want to sell to the Kaiser family or the Fox family. So this program, it stays in your buyer's name. They're buying it in their name. It's not priority buying the house. So I think that could be a turnoff to a seller if they're selling it to a company versus a family.
So let's get back to that then, because I love that, Dave. So are you telling me then that every client I send to you, you guys are going to set them up on this Cash Edge program, and so we're ready for it? But then when I'm assuming that most of the time we won't actually use it, that then we just do normal finance.
Yeah, it's kind of like you're just showing them your guns, but you're not going to use them type of thing. Yeah.
Okay. Well, that's
Yeah,
awesome.
but so the thing is it's not going to, remember though, Jason, that it's no FHAVA or USDA, and then there's no
Right.
manufactured homes. It's just going to be the people that we're pretty certain are going to be, and it. So like in my mind, saying that we'll do that on it's not any different than just saying we want to pre-underwrite everybody we can, because that's all it
Sure.
really requires is we want to pre-underwrite everybody we can.
Right.